Hi, welcome to my video on the tax implications of rental properties. Sorry, I can't promise that this will be overwhelmingly entertaining, but you're here to learn about tax and I'll do my best to make it as interesting as I can. You're being presented to today by myself, you're probably aware. I have a number of degrees and diplomas in these topics, but more importantly I've been a passionate property investor for over 20 years. This material is tax related, but it shouldn't be taken as personal tax advice. So what we're going to look at is what rental income is taxable, what expenses are allowable, what records you need to keep, and what you need to know if you sell your property. The information is current at 2009, nothing's changed since then. However, tax law is continually changing, so always check with your tax advisor. So what is rental related income? It's quite easy. Rental and other rental related income includes all the amounts you receive, whether in cash or not, and whether paid directly to you or not. Things such as rental bond money you keep, reimbursement of expenses by tenants, insurance payouts, booking and letting fees, basically anything you receive in relation to renting the property. Government bonuses such as NRAS and solar rebates. Let's look at co-ownership. I often get asked the question, if you own a property together, can you put the income in one person's name or does it have to go equally? Basically, it has to be divided in line with the legal interest in the property, regardless of whether you have a private agreement to the contrary. For example, at joint tenants, you basically both own an equal interest in the property, being 50-50. Whereas tenants in common can own a property in any proportion, such as 99:1. So it's very important to get advice on this from a tax expert before you actually buy a property, because once you've bought it, it's too late to change. Well, you can change with quite adverse stamp duty consequences. So the only variation to the rule is if you're in a rental property business. However, that doesn't happen very often. There's tax rulings on it if you need to know, but basically it's only used if you have maybe 8 to 10 properties and you're actively managing them, looking after themselves. It's your business. So rarely does that happen. Normally it's always just split in line with the ownership. So let's look at rental expenses. You can claim all expenses you incur for the period where your property is rented or available to rent, for expenses that are capital or private in nature, except for expenses that are capital or private. So that probably doesn't make much sense. So let's have a look at some examples. There's 3 types of expenses. Those you cannot claim, those you can claim an immediate deduction for, and those you claim over a number of years. So let's look at those that you cannot claim first. Acquisition and disposal costs. However, these can be claimed against the capital gain in the end. So these are things such as legal fees to buy the property, stamp duty in most states other than Canberra. Canberra has an anomaly where you can actually claim stamp duty on a property. You cannot claim expenses not incurred by you. That's quite obvious, like things paid for by the tenant. And you can't include expenses not related to rental. So for example, if you have a holiday property you rent, you might be able to claim some expenses, but not any expenses that are not related to the actual rental. Okay, so expenses you can claim immediately. This is just a list. There is more. Basically, I always advise keep the receipts and keep a list of all your expenses, whether or not you think it's deductible. Keep it anyway, because it's better for your tax agent to determine whether it's deductible or not, rather than yourself. So having a look at these, we've got advertising, bank charges, body corporate fees, cleaning, council rates, electricity and gas, gardening, lawn mowing, insurance, interest on loans, which I will talk about in more detail, land tax, lease documents, legal expenses, mortgage discharge expenses, pest control, property agent fees, quantity surveyors fees, repairs and maintenance, which I'll talk about more, secretary and bookkeeping fees, security expenses, servicing costs, stationery and postage, land tax related, such as your tax return, tax agent expenses, travel and car expenses, which I'll also talk about, water charges. There is more, but that is the most common list of expenses you claim immediately against the rental on the property. Let's have a look at interest. And interest really could be a topic of a video on its own because it can get quite complicated. But basically, you can claim interest on loans to buy the land if you have the intention of building a property. So that's a common one where someone might buy the land and it's vacant, so it's not rented. You can actually still claim the interest as long as you have that intention of building the rental property. Apportionment is required if you take out a loan and use part of that loan for private purposes. That's very important as well. I always advise clients, don't have mixed purpose loans. It just makes things far too complicated. When you're getting your loan, definitely seek advice of a mortgage broker who is working closely with a tax advisor to make sure the structure of your loan is correct for tax purposes, correct and easy for tax purposes. So you can claim interest on loans taken out to buy the property, purchase depreciating assets, repairs, renovations. So anything to do with buying and improving and upgrading that property. So what is debt? You might have heard the term bad debt versus good debt. Very easy to explain. Bad debt is for purchasing items where you borrow to purchase items that depreciate in value, like cars and boats. Very often you'll find a few years into the asset life, you actually owe more than the thing is worth. Versus good debt, which allows you to own assets that appreciate in value, such as property and other investments. So interest expenses. The most common question I get asked as a tax advisor is, can I move out of my residence and refinance it to buy another residence to live in and claim the interest? The answer is categorically no, you cannot. Well, you can refinance the property and use the money to buy another residence. That's not a problem, but you can't claim the interest as a tax deduction. Most cases, if you have a loan to value ratio of less than 80%, the client is best for tax purposes to sell the first home, use the equity to buy a new home, and then buy a rental property with a 95% loan to value ratio. So this is what I commonly advise clients to do. It's not the advice they want to hear, but I can show them mathematically how much they will save by doing this and then structuring their property investments correctly going into the future by getting proper tax advice on it. So let's look at repairs and maintenance. To be deductible, repairs must relate directly to wear and tear or damage that occurred as a result of renting out your property. So they generally involve replacement or renewal of a broken part. And they're not deductible if they're capital in nature. So what is capital? Capital expenses are things that replace the entire structure. So an example of a capital versus repair would be replacing the door on a kitchen cupboard because it's broken. That would be a repair. Replacing the entire kitchen is capital. Replacing the taps in the bathroom because they're rusted is a repair. Replacing the entire vanity and all of the plumbing would be capital. Fixing a few palings in a broken fence would be a repair. Replacing the entire fence would be capital. So improvements, renovations and alterations are generally capital. Another trick is that initial repairs, even small things like fixing some palings on a fence, if that is remedying a defect that was in existence when you bought the property, it's still capital. Tax office view it that if you buy a property in a rundown state and it needs work, all the repairs you do are capital. They just add basically to the cost of the property and they're not deductible. However, you could wait a few years and then perhaps they were more likely to be a repair. So you cannot claim these as a tax deduction, but you can claim capital works deductions, which is basically depreciation for some of these items. So what about travel and car expenses? You can claim trips to inspect, maintain and collect the rent. If you fly to inspect the property, stay overnight, return home the next day, then all the expenses are deductible. But if you stay longer, you should apportion the expenses. Like if you say, for example, 4 days, you can really only claim the first 2. Also, if you take family with you, you should claim a portion of the trip, not the whole lot. So their expenses, I also mentioned, deductible over a number of years, so not outright. These are borrowing expenses, and they can be claimed over 5 years. The most common borrowing expense, a large borrowing expense, is lender's mortgage insurance, if you borrow more than 80% on the value of the property. Depreciation on all the plant and equipment within the property can be claimed over a number of years. Trick to that is that items under $300 can be written off immediately, and up to $600 for joint owners. So for example, you were looking at buying a new microwave for a property that you furnish. If it's $299 or $599 for a joint property, you can write it off immediately. But if it's say $310 or $610, then you will need to add it to capital and depreciate it over a number of years. Items under $1,000 also get added to a low value pool and depreciated at a very high rate of 37.5%. So capital works deductions. They're actually the cost of the building themselves, and you can claim them over 25 to 40 years. If you do not have the actual cost, then you need to get a depreciation report prepared by a qualified person such as a quantity surveyor. At WFS Canberra, we can organise those for you. Examples of items that can be claimed are a building or extension, alterations such as adding new walls, structural improvements, pergolas, retaining walls, fences, swimming pools, etc. So the initial building and anything else that gets added to it over time. Capital gains tax. This is a topic in its own right that I will be releasing a video on. In fact, I could probably release 5 videos on it if I felt people would watch them, but I'll just explain the most basic concepts here. So when you sell a property, you will be subject to capital gains tax on the gain you have made. The gain is calculated by comparing the sale price to the purchase price. It's quite a simple concept. However, some people misunderstand and think that the gain will be how much they're selling it for less the mortgage on it, like how much money they're going to get at the end. That's not the case. The gain is the initial purchase price versus the sale price. So as an example, a property costs $300 and you sold it for $450. You've made a gain of $150. You can subtract acquisition and sale costs such as stamp duty, real estate and legal fees. Say $25,000, so your gain is now $125,000. The good news is that 50% of this gain is exempt from tax. So $125,000 times 50%, only $62,500 is taxable. Let's tax at your marginal rate. Let's say you're a high income earner and you're on 38%. So the tax on that gain is only $23,750. So that may sound bad, but on a gain of $150,000, you only pay $23,000 in tax, and in pocket the other $126,250. So some people hold off selling. Actually, some people hold off buying properties because they go, "Oh, you just get taxed on the capital gain." Others are holding properties and not selling them because of the capital gain. The capital gain tax is actually one of the lowest forms of taxation. So definitely worth getting some advice on how much the tax you've really got to pay. You can also reduce capital gains by having properties in joint names so as to reduce the marginal tax rate. You can have properties in self-managed super funds where the gain can be entirely tax-free. I have another video on that seminar. Please watch that one. You can sell properties over a number of years, not all at once. You can sell in years when your income is low. So there are ways to reduce capital gains tax. So definitely seek advice before you actually sell the property. Okay, so what is negative gearing? Negative gearing is when the property expenses are greater than the property income. So what does that mean? The negative geared loss is claimed as a deduction against other income. It often results in a substantial tax refund at year end. You can also choose to have that tax refund paid to you through your pay, through as a pay as you go variation. If the loss exceeds other income, then the loss is carried forward to future years. So even if you're receiving no other income and you're making a loss, you still will eventually get the benefit of a negatively geared property. Let's have a look how it works. The costs and benefits of a property. In this case, the annual costs, such as the interest and the rates and insurance and fees, etc., come to $22,983. The income is obviously the rental income, depreciation, tax breaks, and other tax rebates. So in this example of this property, the total income and benefits is $21,158. So cost less benefits is $1,800 per annum, or $5 a day. But that is a negatively geared property by the tune of $1,825, which you'll get to claim on your tax return. So who pays for your property over time? Basically, the tenant pays for 80%. Taxman gives you an 18% tax break. You only pay 2% of the cost of holding your property, yet you get all the benefit of the gain. By year 10, the tenant is now paying 93% of the property, and you're only paying 7%. How good is that? No, sorry, taxman's paying 7%. You're not paying any, because by now it's a positive cash flow property. So one of the most important things, it's vital that you keep documentary evidence of all the income and expenses related to your property. As I always say, no matter what you spend on the property, keep the income, keep the expenses and the receipts so that you can take them to your tax agent at the end of the year and get their advice. So where in doubt as to whether you can claim something, keep the receipt anyway and let your tax agent decide. Your tax agent would also really appreciate it if you summarise your income and expenses. WFS Canberra actually provide a spreadsheet free of charge to our clients where you can keep it summarised for us. If you do that, we actually give you a 15% discount off your tax return. So more record keeping. You can use an accounting program like MYOB. However, an Excel spreadsheet or manual cash book is just as good. In fact, I find MYOB quite complicated just for rental properties, unless you've got a lot of them and you really like MYOB and really like spending time entering your receipts onto MYOB, because it can be a lot more time consuming than a simple spreadsheet. You need to keep the records for up to 7 years after the tax return is lodged, but you should also keep all records of capital expenses until 7 years after the property is sold. Most people get caught out on that if they've held a property for a long time. They'll come in, they'll sell it, and I'll ask them, okay, so how much did you pay for it? And they've got no idea because it was so long ago and they don't have the receipts. So know where you're going. There's no hope of success for a person who does not have a central purpose or a definite goal. Your investment journey. You may have seen this slide before, but I can't stress its importance. I always talk to my clients about setting up the structure first. Talk to an advisor. Research your options. Get advice. Get it right before you begin. Because those who fail to plan to fail. Set up the structure, prepare the plan, get the finance strategy right, and then start looking for property. You could also have a property portfolio review if you haven't had one already, to say how many properties you can buy, how much you can borrow, how much will it cost you per week, and how should you structure the purchase for tax purposes. This is only $385, which includes an hour consultation and discussion about your plans. If you haven't had one already, email me, catherine@wfscanberra.com.au. We also have a free report about how to build a property portfolio the right way. The free report reveals the 7 elements to building a successful property portfolio. That can also be found at wfscanberra.com.au. We have a lot of other videos in this series which you really should watch to improve your education. I won't go through them all there now. They should all be up on YouTube or in our membership login site for you to have a look at. You could also consider the wealth coaching packages if you're not on one already. More information can be found at wfscanberra.com.au/wealth coaching. We have the wealth breakthrough package, a holistic wealth through property package, and a holistic wealth through business package. So either look on the website or simply contact myself for further information. Thank you for listening to this video today. One of my favourite sayings is, life is a challenge, meet it. Life is love, share it. Life is a dream, realise it. And life is a game, so play it.